So Microsoft just posted a record-breaking $50 billion quarter in cloud services revenue.
Right. I mean, a truly staggering number.
Yeah, it's massive.
Right.
By every traditional metric we use to measure corporate success, it was an absolute victory lap.
Oh, completely.
And Wall Street's reaction, I mean, they hit the sell button so aggressively with such violent conviction that Microsoft lost $357 billion in market value in a single afternoon.
Yeah, in one day.
So welcome to the deep dive. The date is March 14th, 2026, and the ground beneath the enterprise software sector has just completely given way.
It really has because, look, the logic that governed tech valuations for the last 10 years, it's just evaporated.
Right.
We're looking at a market that is not just correcting, it's structurally malfunctioning.
Yeah, so today we are acting as your personal head of technology equity strategy. That's our mission for you. Because the software as a service sector, the SaaS sector, the absolute darling of the last decade, this supposedly impenetrable fortress of recurring revenue, has just experienced a brutal Q1 crash.
Brutal is the right word for it.
So our goal for you today is to conduct a really comprehensive, no stone unturned postmortem of this software sell-off. And then we're going to provide a concrete 12-month strategic outlook.
Right, because we need to figure out if this is really the end of the SaaS era as we know it, or, maybe the greatest 2016-style buying opportunity we've seen in a decade.
Right.
Because in these moments of panic, the worst thing you can do is react to the surface level noise.
Totally. You have to look deeper.
Yeah, you have to understand the underlying mechanics of the sell-off to actually identify the bargains.
And to do that, we've pulled together just a massive stack of intelligence for this deep dive.
It's a lot to get through.
It is. We have urgent market alerts from Morgan Stanley and Barclays.
All right.
We're pulling deep sector-level analysis from Wedbush and JP Morgan. We've got geopolitical market updates on the escalating energy shock in the Middle East. We're also diving into this really fascinating academic study from Maastricht University.
That one is incredible.
Yeah, they analyzed thousands of SEC 10K filings to see what companies are secretly admitting to their lawyers about AI risks. And we're grounding it all in fundamental valuation theses, looking at why discounted cash flow models are just subtly breaking.
It's a phenomenal stack of data. And, it all really revolves around one central tension.
Right.
The market is trying to price in an artificial intelligence revolution, but it is currently caught between the fear of massive infrastructure costs on one hand and the absolute terror of ultimate product obsolescence on the other.
Okay, let's unpack this. Because before we can even begin to understand why software stocks specifically crash so hard, we need to look at the macroeconomic vacuum.
Yeah, we have to start macro.
Because software doesn't trade in a vacuum,
Right.
But it is currently being sucked into one.
Right.
There's this massive flow of capital just leaving the technology sector entirely.
The analysts are calling this the atoms over bits rotation.
Right. Atoms over bits.
Yeah, so capital is fleeing the digital realm, the bits, and aggressively seeking safety in physical, tangible assets. The atoms.
Meaning hardware and energy.
Exactly. We are talking about a massive rotation into hardware, specifically semiconductors, and traditional energy conglomerates like Berkshire Hathaway Energy and Exxon.
So to understand why money is sprinting toward energy and physical assets right now, we really have to look at the geopolitical shockwaves hitting the market.
Yeah, the energy shock.
And I want to be incredibly clear up front here. We are examining these geopolitical events impartially, strictly through the lens of their impact on global capital flows and market liquidity.
Right, pure the math.
Exactly. We are not taking a stance on the politics or endorsing any military actions whatsoever. Our focus is purely on the numbers. So right now, we're looking at an escalating conflict involving Iran and Israel.
Which is severely disrupting the region.
Right. And you have the effective closure of the Strait of Hormuz and recent U.S. military strikes that leveled Iranian military sites on Karg Island, while, and this is notable for the markets, notably sparing their oil terminals.
Which is key. But even so, that geopolitical flashpoint has created a massive, immediate energy shock.
And the mechanics of that shock are what's draining liquidity from the tech sector, right?
Yeah, exactly. Because the Strait of Hormuz is essentially closed to commercial shipping right now, the International Energy Agency, the IEA, is proposing the largest release of oil reserves in its entire history.
Wow. Bigger than 2022.
Much bigger. Officials are looking at a coordinated release that would significantly exceed the 182 million barrels that member countries released back in 2022 after the invasion of Ukraine.
Let's visualize what a release of that magnitude actually means for a second.
Okay.
Because you don't just, turn a spigot and dump 182 million barrels of crude into the ocean.
Right. No.
That is a massive, highly coordinated logistical operation across multiple sovereign nations. They are pumping strategic reserves into commercial pipelines and tankers just to artificially suppress a massive spike in global energy prices.
And while the IEA is playing defense with the reserves, you have Saudi Arabia playing offense with their infrastructure.
What are they doing?
They are rapidly ramping up alternative oil pipelines. Specifically, they are nearing full utilization of their massive east-west pipeline.
Right.
The goal there is to physically bypass the Strait of Hormuz entirely, moving crude directly to the Red Sea. So when you have global superpowers executing logistical pivots of this magnitude just to keep the lights on.
Institutional investors panic.
Exactly. They panic. They don't want to hold speculative software multiples right now. They want to hold the companies pulling the oil out of the ground or the companies building the physical infrastructure to move it.
That physical safety is just paramount. Which brings us to an incredible piece of research from BCA Research, because they are mapping this current environment using what they call the 2000 template.
Yeah, the .com parallels.
Right. They are drawing a direct line between the behavior of capital today and the bursting of the .com bubble.
And honestly, the parallels are striking. BCA strategists point out that in the year 2000, technology shares peaked in March.
Which is eerily similar to our current timeline.
Very similar. And then they fell sharply over the next year. But meanwhile, non-IT stocks, the old economy companies, they actually gained around 10% during that exact same period.
So we're seeing that exact decoupling right now.
We really are.
But the danger, according to DCA, isn't just that tech investors lose money, right?
Yeah.
It's the spillover effect. They estimate that a sustained 10% drop in equities would reduce household wealth by $6.5 trillion.
That's a massive wealth destruction.
Right, and let's break down the mechanics of that wealth destruction, because it's not just numbers on a brokerage statement, it's the wealth effect.
Right, human psychology.
It's exactly. When a household sees their retirement account plummet by 20%, they feel fundamentally poorer, even if they haven't sold a single share.
Yeah, they pull back.
They cancel the kitchen remodel, and then the contractor who is going to do the remodel doesn't buy the new Ford F-150.
Right.
And Ford then scales back production and lays off factory workers. BCA estimates that a $6.5 trillion wealth destruction would cut direct household consumption by roughly $250 billion. That shaves 0.8% off the total GDP.
So this atoms over bits rotation isn't just, a reshuffling of Wall Street portfolio.
No, not at all.
It's a structural threat to the broader economy.
Yeah.
But look, the external geopolitical vacuum is only half the story here. There is a second, arguably more violent vacuum happening inside the technology sector itself.
Right. We have to examine the AI budget cannibalization.
We do. And the scale of the capital being deployed here is almost difficult to comprehend. The hyperscalers, so Microsoft, Alphabet, Amazon, and Meta, are collectively forecasted to spend upwards of $650 billion on compatible expenditures in 2026.
Primarily on AI infrastructure.
Primarily, yeah. Data centers, GPUs, power grids.
Let's put that in perspective for you. Just 2 years ago, in 2024, their combined CapEx was $224 billion.
Right.
They are nearly tripling their physical infrastructure spend in 36 months.
Yeah.
Alphabet alone is carving out up to $185 billion this year. I mean, they are essentially building the GDP of a small country in data centers and GPUs.
And they are taking on massive debt to do it. Because look, these companies print cash, obviously, but even they cannot organically fund a $650 billion build-out.
Right, the bond markets.
Exactly. Alphabet recently issued almost $32 billion in bonds. Oracle borrowed $25 billion. Morgan Stanley projects that big tech could borrow as much as $400 billion this year alone just to secure the physical real estate, the power contracts, and the NVIDIA chips required to train these frontier AI models.
And here is where the cannibalization happens. I want you to imagine you are the chief information officer of a Fortune 500 company. Okay.
Sure.
You have a fixed annual IT budget,
Very fixed.
right? And your CEO has mandated that your company must integrate generative AI into your core workflows or you will fall behind your competitors.
It's an existential mandate.
So you have to pay Microsoft or Amazon massive premiums for this new AI compute power.
Mm.
But your budget didn't magically double.
No, it stayed the same.
So where do you find the money? You find it by starving the application software layer.
Mhm.
You look at your legacy SaaS contracts. You tell your HR department they don't get the new Workday upgrade.
Yep.
You tell your marketing team they have to consolidate their HubSpot licenses. You delay the rollout of the new enterprise project management tool. Every dollar flowing into the foundational AI infrastructure is a dollar being actively ripped away from traditional software as a service vendors.
It's a zero-sum game within the enterprise IT budget.
Yeah.
The foundational layer is acting like a black hole, just consuming all available capital.
But I have to challenge the fundamental premise of this spending spree. Like, are these hyperscalers just building a $650 billion bridge to nowhere?
Well, that's the trillion-dollar question.
Let's look at the BCA research again. They note that enterprise AI adoption rates are actually plateauing right now. The initial wave of experimentation has happened, but the massive transformative productivity gains haven't fully materialized in the macro data yet. Furthermore, GPU rental rates are falling, and the price of AI tokens, the cost to actually run a prompt through a model, is dropping rapidly. We are seeing free cash flow at these hyperscalers decline despite their market cap soaring. If the adoption is plateauing and the pricing power is dropping, isn't this massive CapEx spend just setting fire to shareholder capital?
That is the exact anxiety causing institutional investors to flee. They are looking at the math. If you spend $650 billion on infrastructure, you need an absolutely astronomical return on investment just to break even on your cost of capital.
Exactly.
If the killer application for all this compute power turns out to be just a slightly better chatbot, the hyperscalers will have orchestrated the greatest destruction of capital in modern corporate history.
Wow.
So the market is pricing in the probability that this infrastructure is vastly overbuilt relative to the near-term commercial demand.
So we have a brutal macro environment. Capital is fleeing to hard assets due to geopolitical energy shocks, and whatever money remains in tech is being completely consumed by the hyperscalers building data centers. That creates a terrible environment for software stocks.
It does.
But it doesn't fully explain the sheer existential panic we saw in Q1. To understand the panic, we have to move to the disruption narrative. We have to talk about the SaaS apocalypse.
Right. Because it's one thing to lose budget to a new technology. It is a completely different scenario when that new technology threatens to make your entire product category obsolete.
Yeah. The immediate catalyst for this Q1 crash wasn't just a bad earnings print. It was a product demonstration.
A terrifying one for software vendors.
Specifically, Anthropic rolling out their new Cowork plugins, which are powered by their Opus 4.6 model and their new Claude code security capabilities. Let's break down why a single product launch triggered a sector-wide meltdown.
Yeah, let's do that.
For decades, software has been built on a specific paradigm. A human user interacts with a graphical user interface to manipulate data. You click buttons on a dashboard to generate an expense report or run a legal discovery search.
Right.
Anthropic demonstrated that an autonomous AI agent can bypass the dashboard entirely. A user can simply speak to their computer in natural language, and the AI agent will navigate the complex data layers, perform the analysis, and deliver the result.
And the market watched that demonstration and had a terrifying realization. Why would an enterprise pay millions of dollars a year for a bespoke, highly specialized user interface if an AI agent can achieve the exact same outcome just by reading the raw data?
The market reaction was instantaneous and brutal. Look at legal tech. Firms that specialize in complex legal search software, like Thomson Reuters and RELX, were hammered. Thomson Reuters dropped 28% year-to-date.
28%.
Yeah. But the panic didn't stop at specialized tools.
Right.
It violently bled into cybersecurity, which caught a lot of analysts off guard.
It did, because cybersecurity has always been viewed as the ultimate defensive sector. Like,
Right.
no matter what happens in the economy, you have to protect your network.
Exactly. But the narrative shifted overnight. We
Mhm.
saw CrowdStrike fall 8% in a single session. Cloudflare slumped 8.1%. Zscaler dropped 5.5%. Rubrik fell over 7%. Okta declined 9.2%. Billions of dollars in market capitalization vaporized because of Anthropic's Claude code security.
So let's explain the mechanics of why Claude terrified the cybersecurity market. Traditional legacy cybersecurity software largely relies on pattern matching, right? It looks for known virus signatures or established anomalous behaviors.
Right.
But Claude Code Security utilizes a large language model to actually read and understand the semantic intent of the code base. It doesn't just look for a known bad pattern, it reads the code like a human architect, identifies a logical flaw that could be exploited, and then autonomously generates the patch to fix it.
And investors looked at that capability and extrapolated a nightmare scenario. Because yes, AI will empower malicious actors to generate novel cyber attacks faster. But if defensive AI models like Claude can scan, identify, and patch vulnerabilities faster and more comprehensively than any human security team using legacy software, the legacy vendors might be entirely cut out of the loop.
Right, the AI that writes the code will secure the code.
And the fear extends far beyond just writing code or running legal searches.
Yeah.
We need to look at the Citrini research paper that Valens highlighted.
Oh, the unemployment paper.
Yeah, this paper laid out a hypothetical but mathematically sound scenario where AI automation pushes the U.S. unemployment rate above 10% by the year 2028.
They frame this around the destruction of the what they call the long daisy chain of correlated bets on white-collar productivity.
Right. I want to paint a picture of what that daisy chain looks like for you. Imagine a mid-level logistics coordinator at a major shipping firm. Let's call him David.
Okay, David.
David uses specialized software to route shipments. If an autonomous AI agent proves it can route those shipments 20% more efficiently, David loses his job.
Which is awful for David, but it doesn't end there.
Right. David's job loss isn't isolated. David no longer takes an Uber to the corporate office 3 days a week. David no longer orders DoorDash for his working lunches. David no longer uses his corporate American Express card to book flights on Delta for quarterly regional meetings.
Exactly.
When the Citrini paper dropped, it wasn't just software stocks that took a hit. Shares of Uber, DoorDash, American Express, MasterCard, and Visa all fell by 4% or more. The market suddenly realized that the entire modern service economy, the whole ecosystem of premium consumer services, is fundamentally predicated on high-employment, high-income white-collar workers.
Right.
If you automate the white-collar worker, the ripple effects destroy revenue models across seemingly unrelated sectors.
Which brings us back to the core structural flaw of the legacy software industry, the mechanism that makes them so incredibly vulnerable to this white-collar automation. This is the seat-based compression thesis.
This is the crux of the issue. This is what we call business model debt. Because for the last 15 years, the absolute gold standard for SaaS valuation has been the recurring revenue model, specifically per-seat licensing. Think of it like a gym membership, but instead of paying for the whole family, you pay a separate fee for every single person who walks through the door.
Right.
If you build a CRM like Salesforce or an ERP system, you don't sell the software once. You charge the client a monthly subscription fee for every human employee who has a login credential.
Which was a flawless business model during the boom years. As your client grew their business and hired more humans, your software revenue grew automatically with essentially zero marginal cost to you.
But the Morningstar analysis highlights the fatal flaw in that model when you introduce AI. They put it bluntly. If one person can now do the work of two, seat counts fall.
Exactly. Let's go back to our logistics coordinator, David. Let's say David worked on a team of 10 people, and the company paid a software vendor $100 a month for each of their 10 seats. That's $1,000 a month in recurring revenue. If the company deploys an autonomous AI agent, they might fire 8 of those human workers. The remaining 2 humans just manage the AI. So the company only needs 2 software seats now.
Wow.
The SaaS vendor's revenue just plummeted by 80%, even though the client company is actually moving more freight using their system. The software is creating more value, but because the pricing model is chained to human headcount, the vendor's revenue collapses.
The value capture mechanism is fundamentally broken. And the threat isn't just that companies buy fewer seats, it's that they stop buying the software entirely. We have to discuss the phenomenon Bloomberg is tracking, which developers are calling vibe code.
Vibe code. I mean, it sounds like a joke, but it is terrifying enterprise sales teams.
What exactly is it?
Vibe code is the concept that non-technical users, everyday office workers, can use advanced conversational AI to generate custom software scripts and applications on the fly to solve specific, immediate problems.
So why would a department head go through a 6-month procurement process to buy a clunky, expensive enterprise workflow tool when their team can just spend an afternoon prompting an AI to build a custom, lightweight app that perfectly fits their exact daily process?
Exactly. It democratizes software creation to the point where the end user bypasses the legacy vendor completely. It is the ultimate proliferation of shadow IT, unregulated, undocumented software running inside a corporate network.
Wait, I'm stuck on something here. I want to play devil's advocate for a second.
Okay, go for it.
You're saying everyone in an enterprise is just going to start spinning up their own amateur vibe code to solve daily problems. Wouldn't millions of non-coders creating massive amounts of undocumented, highly vulnerable shadow IT be the greatest gift ever handed to the cybersecurity industry?
You would think so.
Right. If the attack surface of a company just multiplied by 1,000 because Janet in accounting built a custom macro using AI, shouldn't cybersecurity stocks be absolutely ripping to the upside because their total addressable market of fixing mistakes just went parabolic? Why are they selling off?
It is a brilliant point, and it highlights the deep contradiction in the market's current narrative. Logically, a massive proliferation of flawed AI-generated code should trigger a golden age for cybersecurity vendors.
Right.
But the market isn't trading on that logic. It is trading on the fear of vertical integration. The narrative is that the same foundational AI models that empower Janet to write the vulnerable code like Anthropic's Opus will also contain the defensive mechanisms, like Claude Code Security, to instantly patch it.
Oh.
The fear is that the hyperscalers will simply bundle the security directly into the AI generation layer, completely starving the third-party legacy cybersecurity vendors of any new business.
Wow. So the AI creates the problem and sells you the cure, cutting out the middleman.
Exactly.
Okay, so we have firmly established the narrative of fear. We understand the macro vacuum, the infrastructure cannibalization, the existential threat of seat destruction, and the rise of vibe code. Now let's pivot away from the narrative and look at the math.
Let's do it.
Let's look at the actual numerical reality of this bear market. And more importantly, what these companies are secretly admitting in their legally binding corporate filings.
The bear market metrics. And they are exceptionally grim. We're seeing valuations compress at a speed rarely witnessed outside of a broad economic recession.
Let's lay out the carnage for you. The S&P North American Technology Software Index, which tracks 110 of the most prominent software stocks, is down 26% from its September high.
Massive drop.
The BVP Nasdaq Emerging Cloud Index, the Cloud, is down roughly 35% year-to-date. Contrast that with the broader S&P 500, which has largely weathered the storm thanks to the energy and industrial sectors.
Right.
Globally, the pain is identical. In Australia, their tech index is down 25% over 6 months. Former market darlings, companies with incredible margins and sticky products, are being decimated. Atlassian is down 50% since January.
50%.
Yeah. Xero and WiseTech have shed billions in intrinsic value.
And to put this valuation collapse into context, Morgan Stanley analyst Keith Weiss released a report noting that software multiples have dropped 33% since October 2025.
Wow.
The average software multiple has violently compressed to around 4.4 times enterprise value to sales. We are back to valuation ranges we haven't seen since the peak uncertainty of the early public cloud transition over a decade ago.
Let's compare that to where the money is actually flowing. The forward price-to-earnings ratio of the software index has plummeted to roughly 32x. That is a massive drop from its 2021 peak when money was free.
Right.
Meanwhile, the semiconductor subsector, the company designing and manufacturing the physical chips required for AI, is surging. They're trading at around a 43x multiple. The market is happily paying a premium for the hardware, but absolutely refuses to pay for the software.
So how do financial analysts even value a software company right now? This brings us to a deeply fascinating thesis from Diva Portal, analyzing the breakdown of the discounted cash flow model.
The DCF model. This is the bedrock, the absolute foundational mathematics of traditional financial valuation. Let's explain how a DCF actually works, because it's crucial to understanding why Wall Street is flying blind right now.
Yeah, it's a good idea.
Imagine you are thinking about buying a friend's coffee subscription box business. You don't just guess what it's worth. You sit down and project exactly how much free cash flow that business is going to generate every year for the next 10 years. You look at their subscriber growth, their bean costs, their shipping fees.
Right.
But a dollar earned 10 years from now isn't worth a dollar today because of inflation and opportunity cost. So you have to discount those future cash flows back to their present value. You use a discount rate, typically the company's weighted average cost of capital, or WACC.
Think of the WACC as the hurdle rate. It represents the blended cost of the company's debt and the return expected by its equity investors. If a company takes capital and cannot generate a return higher than its WACC, it is fundamentally destroying value.
Exactly. So
Right.
let's run a hypothetical 10-year DCF for a top-tier SaaS company in a normal market. Let's say we expect them to grow revenues at a steady 9% a year, and we apply a standard 10% discount rate. Historically, SaaS companies had 80% gross margins and incredibly sticky, predictable recurring revenue. Customers rarely churned.
Right?
So projecting 9% growth over 10 years was considered a very safe, conservative bet. You plug those steady numbers into the spreadsheet, and the model spits out a massive, justifiable valuation.
But the Diva Portal thesis beautifully articulates why this model is fundamentally breaking down in the age of generative AI. A DCF model requires visibility. It requires a baseline assumption of product permanence.
And we don't have that anymore.
No. How can an analyst confidently sit at their desk and forecast 10 years of cash flow at a 9% growth rate when they know that Anthropic or OpenAI might release a frontier model in 24 months that makes the company's core product entirely obsolete?
You can't. The math breaks. At the end of a DCF projection, you calculate a terminal value, the assumed value of the company extending into perpetuity after year 10. If the market believes that AI automation might drive the terminal value of a legacy software company to literal zero, the entire mathematical structure of the DCF collapses. The present value of the stock plummets immediately.
And this mathematical breakdown leads to a dangerous phenomenon that researchers Maloney and Moskowitz describe as the value trap.
Explain the value trap.
A software stock might look incredibly cheap on paper right now. You look at its current earnings, its current cash flow, and its depressed stock price, and traditional metrics scream that it is a bargain.
Right.
But if the broader market believes those earnings are going to evaporate in 3 years due to AI disruption, that apparent value gap will persist indefinitely. The stock is cheap for a structural reason, and it will stay cheap, trapping value investors who thought they were buying the dip.
So the analysts outside the companies are flying blind, unable to trust their own models. But what is happening inside the companies? What do the corporate executives and their armies of lawyers actually think about this risk? Are they acknowledging it or are they hiding it?
That's a great question.
To answer that, we're looking at an incredibly revealing academic study from the Law and Tech Lab at Maastricht University. They executed a massive, systematic analysis of AI risk disclosures embedded in SEC 10K filings.
And for those unfamiliar, a 10K is not a marketing brochure.
No, definitely not.
It is the legally binding, incredibly dense annual report that public companies must file with the Securities and Exchange Commission. Crucially, they are legally required to list all material risks to their business operations. If executives lie in a 10K or intentionally omit known existential risks, they can face severe shareholder litigation and potentially criminal fraud charges.
Right.
So the 10K is the one place where corporate lawyers force management to tell the absolute truth.
And the truth they found is staggering. The researchers at Maastricht analyzed over 30,000 individual filings from more than 7,000 public companies over the past 5 years. They found that explicit mentions of artificial intelligence as a material risk factor jumped from just 4% of companies in 2020 to over 43% of companies in the 2024 filings.
That is a 7-fold increase across the entire public market in just 48 months. The corporate lawyers are terrified.
So what exactly are they terrified of? Let's break down what they are actually disclosing to the SEC.
The study categorizes these disclosures into 3 main buckets. First, legal risks. This is currently the most prevalent concern. Companies are expressing deep anxiety over regulatory uncertainty and compliance burdens, specifically regarding comprehensive legislation like the 2024 EU AI Act. But the bigger fear is intellectual property liability.
Right. The copyright nightmare.
Oh, yeah.
If an enterprise deploys an AI coding assistant, and that AI hallucinates and spits out a block of proprietary code that it scraped from a competitor's copyrighted repository, and the enterprise pushes that code into their live product, who gets sued?
Exactly.
The enterprise or the AI creator. The liability chain is completely unresolved, and companies are warning investors that a single massive IP lawsuit could cripple them.
And the second category is competitive risks. This is the raw fear of falling behind in the AI arms race. Companies are formally disclosing the massive, highly uncertain capital investments required just to maintain parity with their peers. They are telling investors, we have to spend billions on AI integration. We don't know if it will actually improve our product, but if we don't spend it, our competitors will crush us.
It's basically a hostage situation.
It really is.
And the third category is societal risks. This is where the filings get genuinely dark. Companies are actively warning their shareholders about the impending wave of AI-enabled cyberattacks, deep fake social engineering fraud targeting their executives, and massive internal privacy breaches caused by their own employees accidentally feeding proprietary data into public AI models.
Look at Baker Hughes, a massive global energy technology company.
Right.
They aren't a software startup. They deal in heavy industry. But they specifically stated in their filing, quote, cyber attacks are expected to accelerate on a global basis in both frequency and magnitude as threat actors become increasingly sophisticated in techniques and tools, including artificial intelligence.
They are bracing for impact.
They are. But the analysis of these 10K filings reveals a deeper, more insidious trend that the SEC itself is actively targeting. Gary Gensler, the former SEC chair, repeatedly warned public companies about the dangers of AI washing.
AI washing. It's like greenwashing, where an oil company runs an ad campaign about planting a few trees but applied to tech.
Precisely. The Maastricht study found that while companies are eagerly listing AI as a risk factor to satisfy their legal obligations, they are doing so using incredibly vague, hypothetical, boilerplate language. They use phrases like, AI may disrupt our operations, or we could face new competition. Furthermore, many tech companies are actively externalizing the societal risks. They write paragraphs blaming shadowy third-party hackers for the rise in AI cyber attacks, but they completely fail to acknowledge their own corporate role in developing, funding, or deploying the underlying open-source technologies that make those advanced attacks possible.
Interesting.
They are failing to detail any concrete risk mitigation strategies. They are saying AI is risky, but they are utterly refusing to tell their investors exactly how vulnerable their specific product line, their specific revenue stream, is to being permanently replaced by a large language model.
They are hiding the true depth of the disruption risk behind a wall of corporate legalese. Okay, let's take a breath. We have mapped a terrifying landscape here.
It's a lot of bad news.
It is. We have an external macro vacuum draining liquidity. We have an internal tech vacuum where hyperscalers are burning $650 billion on data centers, starving SaaS budgets. We have a business model fundamentally tied to human headcount in an era of AI automation. We have valuation models that rely on predictable futures that no longer exist. And we have corporate lawyers burying the existential threat in fine print.
That's oblique.
It sounds entirely hopeless for the SaaS sector. It sounds like a permanent structural decline. But is it?
That assumption is exactly what creates opportunity. This brings us to the core of our strategy session, the baby with the bathwater thesis, the contrarian view.
We have undeniably hit peak pessimism. The market is bleeding out. But if we look at the actions and statements of the smartest, most capitalized minds in global finance and technology, are they actually buying into this doomsday scenario?
The answer, overwhelmingly, is no.
Right. Let's start with the perspective of the man who arguably understands the AI landscape better than anyone on Earth. Jensen Huang, the CEO of NVIDIA.
Yeah, the man selling the pickaxes in the middle of this AI gold rush.
Exactly. When he was pressed about this violent software sell-off, he dismissed the panic entirely. He stated that the idea that generative AI will replace the software industry is the most illogical thing in the world. His thesis is that AI is not a standalone replacement for enterprise operations. It is a profound tool that will utilize existing software platforms to make them infinitely more powerful. The AI needs a structure to operate within.
And the financial analysts who look past the daily noise agree with him. Let's look at Dan Ives, the highly respected tech analyst at Wedbush. He was speaking recently at the Future Proof conference in Miami, and he called this current software weakness the most disconnected trade he has seen in 15 to 20 years of covering the sector.
Most disconnected trade.
Yeah. He believes the market's concerns about AI instantly disrupting entrenched legacy firms are wildly overblown, bordering on hysterical.
He used an incredible phrase to describe the market psychology right now. He called it a Miami cab driver contrarian signal.
It's a modern update to the oldest Wall Street adage. The old saying goes, when the shoeshine boy starts giving you stock tips, it means the market has peaked and it's time to sell.
Right.
But that retail sentiment indicator works in reverse, too.
Exactly. Dan Ives said, right now the Miami cab driver is bearish in software, and I think that's a bullish sign. When retail sentiment and even institutional herd mentality becomes universally, unquestioningly bearish on an entire sector, historically, that is the exact moment of maximum financial opportunity. That's when you start buying.
He calls this current sell-off an AI ghost trade. People are dumping fundamentally sound companies based on phantoms, on hypothetical scenarios of 5 years from now, rather than the reality of the cash flows today.
But we can't just blindly buy the dip across the entire sector, right?
Yeah.
Because some of those phantoms are real. Some companies will be destroyed by AI. So how do we separate the survivors from the casualties?
That requires a deep understanding of the concept of an economic moat, and specifically how an enterprise moat functions in an AI-native world.
This is the most crucial framework for our strategy. Lachlan Holloway, a brilliant equity market strategist at Morningstar, laid this out perfectly. You have to take the entire software landscape and brutally divide it into two distinct categories: systems of record versus systems of engagement.
Right.
Let's drill down into what these actually mean, because this is the dividing line between bankruptcy and massive upside.
So a system of record is the foundational bedrock data layer of an enterprise. It is the deep, highly complex, deeply integrated proprietary database where a company stores its absolute most critical private information. We are talking about decade-long customer purchase histories, granular supply chain logistics, proprietary financial ledger data, and deeply sensitive HR compliance records.
And crucially, an AI model cannot just scrape this data from the public internet. OpenAI cannot train its next model on a Fortune 500 company's internal supply chain bottlenecks because that data sits behind a massive corporate firewall. It is walled off, private, and owned by the system of record.
Exactly. Conversely, a system of engagement is merely the UI layer. It's the pretty dashboard, the chat interface, the drag-and-drop workflow management tool that sits on top of the data. Its only job is to make the raw data digestible for a human user.
And this is where the moat is revealed. If your software company simply provides a pretty user interface, if you are purely a system of engagement, you are in massive existential trouble. Because an AI agent doesn't need a pretty dashboard. An AI agent can interface directly with the raw data via an API and build a perfectly customized user interface on the fly for whatever the user asks. System of engagement is entirely replaceable.
Yeah.
But if your software company owns and manages the proprietary data itself, if you were the system of record, you are safe. In fact, your value just multiplied. Because an AI agent is completely useless without accurate real-time context. The AI needs your data to function. The system of record becomes the indispensable fuel source for the AI revolution. But I have to push back here. I have to look at this like a skeptical listener. If this distinction between systems of records and systems of engagement is so clear, and if the market is supposed to be this hyper-efficient discounting mechanism, why did they aggressively dump Microsoft?
Wow.
I mean, we started this deep dive with that fact.
Yeah.
Microsoft posted a record $50 billion cloud quarter. Azure is the ultimate undisputed system of record for thousands of global enterprises. Yet Wall Street dumped them and wiped out $357 billion in value in a day. If Azure is the safest place to be, why the massive sell-off? Is Wall Street just completely bipolar right now?
It is a totally valid challenge. The reality is that markets in the short term are rarely perfectly rational discounting mechanisms. They are currently narrative-driven, not fundamentally driven. We are in a highly volatile emotional period where institutional traders are swinging wildly between extreme optimism and extreme fear.
Right.
As Holloway from Morningstar pointed out, there's a deep fundamental contradiction in how the market is currently behaving.
Walk me through the contradiction.
The market is suffering from cognitive dissonance. It is simultaneously terrified of too little AI and too much AI.
How does that work?
On one hand, they look at the hyperscalers like Microsoft and Amazon spending $650 billion on data centers, and they panic. They punish the stock because they fear there is too little AI adoption happening in the real world to ever justify that capital expenditure. They fear the ROI won't materialize.
Yep, okay, that makes sense.
On the other hand, they look at traditional SaaS companies and aggressively dump their stock because they fear there is too much AI capability and that autonomous agents are going to automate all the software jobs away tomorrow.
Wow.
You cannot logically hold both of those fears at the exact same time. Either AI is adopting slowly and SaaS is safe for now, or AI is adopting rapidly and the hyperscaler infrastructure spend is fully justified. But the market is panic selling in both directions simultaneously.
They are reacting to two mutually exclusive nightmares. And when the market panics irrationally, it creates massive price dislocations. And price dislocations create generational buying opportunities.
Exactly.
We also have a massive structural signal that corporate executives believe the market is wrong. We are seeing a massive surge in corporate buyback programs. Look at Salesforce. They just authorized a staggering $50 billion share repurchase program.
50 billion.
Let's think about what that means. Salesforce management is looking at their internal data, their pipeline, and their AI integration, and they are looking at their crashed stock price. They are essentially telling Wall Street, you are so completely wrong about our vulnerability to AI that we are going to use $50 billion of our own cash to buy our stock from you at this massive discount. Buybacks of that magnitude often act as a concrete sector floor.
Exactly. They are putting a hard floor under the valuation.
So let's get to the actionable intelligence. We have diagnosed the disease. Now let's prescribe the treatment. It's time for the head of technology equity strategy to deliver the final verdict and the 12-month outlook. If the market is irrationally pricing in a structural decline, where do you, the listener, actually put your money to work in this environment?
We have rigorously culled the research reports, the buy lists, and the analyst upgrades from Morgan Stanley, Barclays, JP Morgan, and others to identify the 7 best bargains from this software sell-off. These are the systems of record, the deeply entrenched platforms that are uniquely positioned to not just survive the AI transition, but to leverage it for massive upside.
Let's dive deep into the 7 picks. Pick number 1, and arguably the most important, Microsoft. Ticker MSFT. Despite that recent, massive $357 billion wipeout we discussed, the fundamentals here are undeniable. The median target price from 60 major analysts covering the stock is currently sitting at $600 per share. Based on where it's trading post-crash, that implies a massive 47% upside.
The underlying metrics for Microsoft are astonishing, and they completely contradict the market's fear of too little AI adoption. CEO Satya Nadella just reported a 160% jump in paid Microsoft 365 Copilot seats in a single quarter.
Oh.
That isn't experimentation. That is aggressive paid enterprise deployment. They are successfully monetizing generative AI at the application layer.
Right.
But the real engine is Azure. Azure just captured 21% of the total global cloud infrastructure market share, and that growth is being driven entirely by enterprise demand for AI compute. Azure is the ultimate system of record. If a Fortune 500 company wants to securely train a model on their proprietary data using OpenAI's frontier models, they have to do it through Azure. Microsoft is the toll booth for the enterprise AI revolution.
Pick number 2, Salesforce. Ticker CRM. They were the poster child for the seat destruction panic. The market assumed that if AI automates sales and marketing tasks, Salesforce loses all its human seat licenses and dies. But Barclays has vehemently disagreed, naming Salesforce a top pick for 2026.
Right. Barclays believes the market fundamentally misjudged Salesforce's ability to pivot. The stock was punished so severely during the panic that it is currently trading at an incredibly cheap 14 times enterprise value to free cash flow based on calendar year 2027 estimates. That is a deep value valuation metric for a company that historically commanded massive growth premiums. Furthermore, the data shows their pivot to AI is actively working. Their AI-related annual recurring revenue, their ARR, jumped 114% year over year. They aren't just selling human seats anymore. Products like their new Agentforce platform and their entirely redesigned AI-native Slack bot are proving that Salesforce can successfully deploy autonomous agents into enterprise workflows and, crucially, charge for them. They are cannibalizing their own legacy model before a competitor can.
Pick number 3, Oracle. Ticker ORCL. Oracle had a volatile roller coaster of a year in 2025, but if you look past the stock chart and look at the actual contracted business, the numbers are staggering. Their remaining performance obligations, which is essentially their legally contracted backlog of future revenue that hasn't been billed yet, more than quadrupled to $553 billion.
Let that number sink in. Over $500 billion in signed, contracted future revenue. Their underlying cloud revenue climbed 44%. Barclays analysts point out a critical timeline. As this massive RPO backlog actually converts to recognized revenue in the second half of 2026, it will mathematically validate Oracle's projections that AI workloads carry incredibly high gross margins.
And there is a wild, massive geopolitical catalyst sitting in the background here, too. Oracle is a key part of the investor group heavily favored to close the deal to buy TikTok's U.S. operations to satisfy national security mandates. If that deal goes through, Oracle doesn't just get a massive captive cloud infrastructure customer. They secure an absolute ocean of proprietary consumer engagement data, creating a consumer system of record to match their enterprise dominance.
Incredible upside. Pick number 4 is Datadog, ticker DDOG. Analysts have a median price target of $180 on the stock, implying a 42% upside. Datadog operates in the observability and security software space.
Now, we need to explain why observability is suddenly the most critical infrastructure layer in the AI era. Why is monitoring software a massive buy?
Because of a phenomenon we call the hallucination cascade, large language models are probabilistic, they hallucinate, they make logical errors, and occasionally they generate completely fabricated outputs.
Right.
If you are a consumer using a chatbot to write a poem, a hallucination is funny. If you are a global bank deploying autonomous AI agents to execute millions of microtransactions or route secure financial data, a hallucination is a catastrophic liability.
Oh, absolutely.
An error by one agent can trigger actions by other agents, creating a cascade of automated failures. Enterprises absolutely must have rock-solid, deep-code monitoring infrastructure to catch these anomalies the millisecond they occur before they impact the live environment. Datadog has an incredibly powerful proprietary AI engine called Watchdog that automates this anomaly detection across massive, complex cloud architectures. Morgan Stanley notes that Datadog has consistently been the top share gainer in the observability market for several years, and the deployment of unpredictable AI agents will act as a massive accelerant for their services.
Pick number 5 is a small cap play that requires a deeper look. DigitalOcean, ticker DOCN. This is a fascinating strategic pivot story highlighted in the Barclays report.
Yes. Under new executive management, DigitalOcean took a hard look at the landscape and made a very rational, very difficult decision. They realize they simply do not have the balance sheet to compete with Microsoft, Amazon, and Google in building massive, multi-billion-dollar data centers packed with high-end NVIDIA GPUs to train new frontier AI models. It is a capital-intensive losing game for a smaller player.
Right.
So they pivoted entirely. They abandoned the model training arms race and focused aggressively on the AI inference market.
Let's clearly define the difference between training and inference, because it's where the profit margins live. Training is reading the entire internet to teach the AI how to think. It takes months and costs billions. Inference is what happens after the model is trained. Inference is the actual execution. It's the AI answering a user's prompt in real time.
Exactly. Inference requires significantly less raw compute power, it utilizes cheaper specialized chips, and crucially, it offers vastly higher profit margins for the cloud provider. And over a long enough timeline, the inference market, the daily usage of AI, will be exponentially larger than the training market.
Wow.
DigitalOcean is bringing 30 megawatts of specialized AI inference capacity online to serve the specific, highly profitable niche for mid-market developers. This allows them to capture the massive tailwinds of AI usage growth without destroying their balance sheet with unsustainable capital expenditures.
Pick number 6. GitLab, ticker GTLB. This is a pure mathematical valuation play in the developer tool space.
According to the quantitative data parsed from Simply Wallsaint, GitLab was caught so violently in the broader software sell-off panic that its valuation multiples compressed to an irrational level. It is currently trading at a price-to-sales ratio of just 4.06x.
Which, for a company with their historical growth trajectory and market position in the DevOps space, is incredibly cheap.
Extremely cheap. Simply Wallsaint utilizes a complex valuation model to calculate what they call a fair ratio. This model adjusts for future earnings growth outlook, structural profit margins, and sector-specific risk factors. They calculate GitLab's true fair ratio at 5.53x, so the stock is currently trading at a massive, unwarranted discount to its intrinsic fair value. It is a very rare value investing opportunity in the typically high-priced, high-growth developer operations sector.
And finally, pick number 7, Shopify, ticker SHOP. Morgan Stanley highlighted them with an incredibly high conviction rating.
Shopify is a brilliant example of a deeply entrenched system of record. They are essentially the underlying operating system, the financial and logistical backbone for millions of independent e-commerce businesses globally. They hold the proprietary data on consumer buying habits, inventory velocity, and payment processing.
Right.
Morgan Stanley believes Shopify is deploying AI perfectly. They aren't using AI to replace their core product. They are building AI tools directly into the platform to make their merchants more efficient. They are giving a mom-and-pop retailer the predictive analytics and automated marketing power of a massive corporation. Because Shopify's revenue model takes a percentage cut of the total transaction volume processed on their platform, if their AI tools help their merchants sell more goods, Shopify's revenue scales automatically. They have built an incredibly deep, highly defensible moat around global e-commerce infrastructure.
So those are the 7 structural winners. But before we finalize this 12-month outlook, we have to address the elephant in the room. We have to talk about the margins.
Yes, the margins.
Because for the last decade, the SaaS industry has enjoyed ridiculous, almost magical 80% gross profit margins. It's what made them the darlings of Wall Street.
Yeah.
The core bear case right now is that the massive underlying compute cost of running complex generative AI queries, paying for those API calls every time a user prompts an agent, is going to structurally crush those gross margins down to 55% or even lower. Right? If the costs explode, how do these companies actually survive that margin compression?
This is the final critical piece of the puzzle for our strategic outlook. It is the concept of survival of the native. Legacy SaaS isn't dying, it is being forced into a painful evolutionary leap. And the only key to survival, the only way to protect those margins, is the aggressive transition to hybrid pricing models.
I'm struggling to see how a company survives if they don't charge a flat fee per human seat anymore. Are they basically turning into utility companies? Are they going to start charging by the kilowatt of compute power?
That is an excellent analogy, and it's exactly what is happening.
Right.
Software companies simply can no longer rely purely on the old seat-based licensing model. Think about the math. If Salesforce charges a client a flat $100 a month for a seat, but the user sitting in that seat spends all day running incredibly complex generative AI queries that cost Salesforce $150 in API compute fees paid to OpenAI, Salesforce is losing money on every transaction.
Oh, yeah.
Their costs now scale with usage, not with headcount. So they must evolve their billing architecture immediately. A hybrid pricing model combines the old and the new. You charge a much lower base subscription fee simply for access to the platform, the connection fee in your utility analogy. Then you layer a consumption-based or outcome-based tier on top for the actual AI usage.
Like paying a flat fee to be connected to the power grid, and then paying a variable rate for the actual kilowatts of electricity you consume each month.
Precisely. If an enterprise client wants to run 1 million complex AI tokens through Salesforce's Agentforce platform to automate a marketing campaign, Salesforce will dynamically charge them based on that specific token consumption.
That makes total sense.
This model does two critical things. First, it allows the software vendors to pass the variable, unpredictable compute costs directly onto the customer, effectively immunizing their gross margins from the high cost of AI inference. Second, it allows them to capture the immense value generated by the AI. The companies that successfully pivot their billing architecture to hybrid pricing will absolutely thrive. They will become the utilities of the new economy. The legacy vendors who stubbornly cling to pure per-seat licensing, hoping the old days return, will slowly bleed to death as compute costs consume their margins.
Okay, let's bring this massive analysis together. We started this deep dive looking at a market in utter panic. We mapped the macroeconomic vacuum, the massive flight of capital to hard assets and energy, driven by the geopolitical shock in the Middle East. We looked at the internal vacuum, the $650 billion hyperscaler infrastructure build-out that is actively starving the application layer of enterprise capital.
We then dissected the narrative causing the localized panic in software. We looked at the fear of seat destruction caused by white-collar automation. We looked at the very real threat of Anthropic's cowork and the rise of vibe code replacing bespoke enterprise tools. And we confronted the harsh reality of corporate lawyers admitting deep vulnerabilities in their SEC 10K filings, hiding behind AI washing.
But then we looked past the narrative and focused on the math. We saw a market where valuation multiples have irrationally crashed 33% back to decade lows, where phenomenal earnings reports are met with historic multi-billion-dollar sell-offs. We identified Dan Ives' Miami cab driver, signal a market driven by emotional fear rather than fundamental cash flows. And crucially, we separated the highly vulnerable systems of engagement from the deeply entrenched, defensible systems of record.
Which ultimately led us to our strategic verdict and our 7 top picks: Microsoft, Salesforce, Oracle, Datadog, DigitalOcean, GitLab, and Shopify. These are the companies armed with the proprietary data and the structural moats, poised to not just survive this crash, but to rebound massively as they transition to native AI architectures and defensive hybrid pricing models.
We started this hour by noting that the enterprise software sector looked like a skyscraper built on a major fault line. The ground is definitely shaking. The disruption is real. But what we found is that the foundational steel of the industry, the proprietary enterprise data, and the deeply embedded daily workflows is vastly stronger than the market currently believes.
The final verdict is clear. The weak, UI-dependent structures will undoubtedly fall. But the fortresses built on systems of record will stand. We're looking at a 2016-style generational buying opportunity masked as a structural decline.
But I want to leave you with one final, slightly mind-bending question to mull over as you analyze your own portfolio this week.
Mm,
We have spent this entire deep dive obsessing over the fear of human workers losing their software seats. We've worried about the resulting revenue drop when a company fires 10 humans and replaces them with an AI agent. But let's take that a step further. What happens to software revenues when these autonomous AI agents officially become the new employees of the enterprise? When an AI is acting as a fully autonomous logistics coordinator, it still needs to access the enterprise resource planning software. It still needs to read the databases, update the ledgers, and execute the routing commands.
it does.
Will SaaS companies figure out how to start legally charging AI agents for specialized software licenses? If your company's proprietary AI agent is logging into and heavily utilizing another company's AI platform to do its job, who pays the subscription fee? Does the agent have its own budget? We are moving from a business-to-business economy to an AI-to-AI economy.
It is a completely new paradigm of economic exchange.
It truly is. Thank you for joining us on this deep dive. As your head of technology equity strategy, our advice is to keep questioning the narratives, look past the panic to the underlying math, and we will see you next time.